Hello, guys. Welcome all. I'm your host, CPA Deko Mohammed. Today focus is on VAT. I want to explain for you the background of VAT. So by the end of this lesson, you should be able to define VAT and explain this background. You also explain the value addition of VAT, the types of VAT registrations, VAT, VAT legislations, the VAT charge to tax, which is found in Section 5 of the VAT Act, credit note and debit note. Finally, VAT tax inclusive and exclusive. So if you begin with the first slide, you need to know what the definition of VAT. VAT is a general tax that applies on the value added in principle to all commercial activities involving the production and distribution of goods and the provision of services. So what do you get from here? Here we're being told that value added, this is the key term, the value added. If you look at this, this is the key term. Let me bold it so that you're able to see it clearly. That is the value added. And then involving the production and distribution of goods, we have the production and distribution of goods, and also the provision of services. So the value added on the distribution and production and distribution of goods, and the provision of services. So any value added to the principal amount, which involving the commercial activities, that is production and distribution of goods and the provision of services, VAT. In simple terms, goods and services, provision of goods and services. And then you look at the value added. And then VAT is a consumption tax because it is borne by the final consumer. It is a tax on personal spending and not charged on business. Oh, what do I mean by this? Let's say you are a customer. You purchase goods from the supermarket. The supermarket will issue to you a receipt which is VAT inclusive. It means the VAT is included. You are going to pay as part of the price. So it means you are the final consumer who has consumed, who has paid the VAT and not charged on a business. We are going to see the distribution just in a few seconds. Then you are told it is charged as a percentage of the price, which means that the actual tax burden is divisible at each stage in the production and distribution chain. This one I want to explain with this through this diagram. I want to explain that point through this diagram. Let's say we have this, there's a producer, and we also have the manufacturer. So let's say this manufacturer has purchased goods worth, let's say, 50,000. So if this manufacturer purchased goods worth 50,000 from the producer, it means the producer will sell the goods to manufacturer inclusive of VAT, 50,000. Then once the manufacturer has paid 50,000, which is the inclusive of VAT, and this manufacturer will have to increase the transaction cost. It will increase the transaction cost, TC, transaction cost, and also some profit. You have to make some profit. You also include the some profit. You will include also a profit to make, and finally, you will also include the VAT component. So by the time the retailer, by the time the manufacturer, the retailer is getting the goods from the manufacturer, then it will have added the the transaction cost, the profit, and the VAT component. This chain is like this. When we have the, we can have the chain like this. So this is the producer selling goods to manufacturer, and manufacturer is also selling to, sorry, the manufacturer is selling to also to the retailer. The manufacturer is selling also to the retailer. And then the retailer will also sell to the consumer. So when I was talking about this process of VAT, when I was explaining the goods that the manufacturer will sell, the price that the manufacturer will sell to the retailer, and I said, let's say this is the 50,000 is the price that the producer sold to manufacturer. This manufacturer will have to increase the transport cost that he has used to produce to transport the goods, and also will have to increase with the profit and also VAT. That means he might even charge he might even charge the amount by the time this manufacturer will receive the goods, he will receive it at, let's say, 150,000. 150,000. This 150,000 now is it is the price which the manufacturer sold to the retailer, which include the transport cost, the profit, and the VAT. And this retailer now, he'll also increase the transport cost, the profit, and the VAT. Now, by the time the consumer will buy the product, he will even sell it at 300,000. You see now, this product have moved from 50,000 to 300. Now, that value added is what we charge to VAT. And remember now, this consumer will pay the final, he will the one who is going to have the burden of the tax, because he's the final consumer. Another point you need to know that when we say VAT is neutral, this manufacturer, but when he pays VAT 16%, he's going to claim as an input VAT when he's going to sell as sales. So it means it will cancel each other. The same case for retailer, but now consumer, you have to have the final burden. That is the process you need to understand when we say it is a value added. Value added. We move on. Next is how VAT is collected. You need to know that VAT is collected fractionally by a system of partial. VAT is collected fractionally via a system of partial payment, whereby taxable person, i.e., the VAT registered business, deduct from the VAT they have collected the amount of tax they have paid to another taxable person on purchase for their business activities. Like this, when we say that, let's say we have the supermarkets. The supermarket, they buy goods from, let's say, the wholesaler. When the wholesaler sell goods to the supermarket will pay input VAT because they purchased the goods from the wholesalers. And then now, when the supermarket is selling goods to the consumer, then they will sell it by adding VAT component. That's why when we say that it's a partial payment, whereby the taxable person, like for this case, the supermarket is the registered business. They deduct VAT they have collected from the amount of tax they have paid to another taxable person. The other taxable person here is the wholesaler. They have to deduct the amount they paid to the wholesaler on purchases for their business activities, and then paid to the revenue authorities by the seller of the goods, who is the taxable person, but it's actually paid by the buyer to the seller as part of the price, that indirect tax. For this case, when the supermarket sell goods to you, let's say you have purchased 2 pens, each at 50 pop, 100. Then if you add VAT, let's say it is 150. So if I purchase the 150 from the supermarket, that is the price inclusive of VAT. Now, it's not my, as the buyer, it's not my duty to pay KRA. Me, I have already paid the amount which is inclusive of VAT. Now, it is the registered person, which is the supermarket, who should be accountable for the VAT. That's why we said it is paid to the revenue authority by the seller of the goods, who is the taxable person, but it is actually paid by the buyer to the seller as part of the price. Now, the VAT was 50. I paid that 50 as the price for the pen. Therefore, it is the duty of the supermarket to report that, to account that to the revenue authority, not the consumer. Next, we have VAT legislation. We are going. These are the laws which are the sources of VAT laws. The first one is VAT Act 2013, which received a presidential accent on 14th August 2013. It was published in Kenyan Gazette on 23rd of August 2013, and it commenced 2nd September 2013, which is divided into 17 parts, and it has 68 sections. It has 2 schedules. First schedule, part 1 and 2. Second schedule, part A, B, and C. Remember, first schedule is all about exempt VAT. All the goods. Part 1 is about goods, and 2 is about services. So if you talk about the first schedule, it's talked about the exempt VAT. And the second schedule is all about zero-rated VAT. Now, that is the VAT Act 2013, which is the main sources of VAT, because every time you're going to use, you want to argue a case, you have to note the act and derive where you have gotten your point of view that you want to defend. Then we have the VAT regulations, which is gazetted on 1st April 2017, legal notice number 54 in the year 2017. The next one is TPA, that is Tax Procedure Act 2015. It also forms a basis for VAT legislation. The other one is Annual Finance Act. If you're in Kenya, you remember the Finance Act 2023 was the one which was the most debated act. And now you remember that act can now change some of the components of VAT. So it will affect the VAT. Now you have to take note of that, the Annual Finance Act. We also have the Miscellaneous Amendment Act. Finally, we have the case laws and judicial intercedents. That is all about the sources of legislation for VAT. The next one is about the types of VAT registrations. We need to talk about the types of VAT registrations. Now, who is supposed to register for VAT? The first registration we call threshold registration. We call it threshold. Now, in the course of the business, the person has made or expect to make a taxable supply, and the value of the taxable supplies is 5 million shilling or more than any period of 12 months. You have to register within 30 days of becoming liable by applying to the commissioner for registration in the prescribed form of iTax. So if you are expecting to make 5 million or you have made a 5 million sales, then you need to register within 30 days of becoming liable. Let's say you derive that 5 million on 1st of January. You have until that 1st of January to register for VAT. Unless if you don't register, it will become another case. Now, what do I mean when I say the person has made or expect to make? Maybe you are trading with business that can generate 5 million sales easily. If you are selling motor vehicle, just one sale of motor vehicle will make you to register for VAT. Now you need to understand your environment. If you can project that you can make the 5 million sales within the 1 year, 12 months, then you need to register for VAT. This is called threshold registration, whereby you have made the 5 million sales. You are able to register for VAT through threshold registration. The other one, the other VAT registration, we call it forced registration. Forced registration is whereby when a person is eligible to apply for registration, but he has not done so within the specified time limit, the commissioner shall forcefully register the person immediately using the iTax portals. Let's say you have attained 1st of January, you have attained the limit of 5 million, but they are not registered. And remember, you say you only have 30 days from the time you attain the 5 million. You have 30 days to register. The 30 days have lapsed and you haven't registered. So the commissioner will forcefully register you, and we call it forced registration. The other registration is voluntary registrations. We have voluntary registrations. This is where the person has not met the registration threshold of 5 million, but maybe for his own reason may apply to the commissioner for voluntary registrations. So we said we have threshold registration whereby you meet the 5 million. The first registration whereby you have not met the 5 million, you have met the 5 million, but you fail to register. That is forcefully. The commissioner will register you forcefully. Then we have the voluntary registrations. Now, you need to note this. The 5 million threshold does not include exempt supply. Exempt supply. The 5 million threshold does not include the exempt supply, because exempt supply, they are not taxable supplies, and VAT is on taxable supply. So anything exempt, which is stated in the first schedule of the VAT Act, is not included in the threshold. Number B is the taxable supply of a capital asset of the person. If you are trading with a capital asset, then the sale of the capital assets will not be included as the threshold for the 5 million. The last one is about taxable supply made solely as a consequences of the person selling the whole or part of the person business or permanently ceasing to carry on the person business. When you sell your business or you permanently cease to carry on the business, provided that is only solely for the consequence of the person selling the business, then you're not supposed to include that as a threshold for the 5 million sales. So we have VAT charge to tax, which is found in section 5 of the VAT Act 2013. A tax to be known as a value-added tax shall be charged in accordance with the provision of the Act. A is a taxable supplies made by a registered person. Taxable supplies made by a registered person. We have three things that are charged to VAT. The first thing is the taxable supply made by a registered person in Kenya. Sorry. The taxable supplies made by a registered person in Kenya. Number two is all about the importation of taxable goods. And finally, the supply of the imported taxable supplies. So if you make these three, let me highlight them so that you're able to see it. These three that I have highlighted here. The taxable supply made by a registered person in Kenya, the importation of taxable goods, when you import taxable goods, and also when you import taxable services, all of these three will be charged to VAT. I said here, NB, taxable supplies is any supply that is not exempt. This means that any item that is not listed in the first schedule of the VAT Act 2013 is a taxable supply. Anything that's not found on the first schedule of the VAT Act 2013 is a taxable supply. Anything that is not in the first schedule, that means anything that is not exempt is a taxable supply. Next is about credit note. Credit note. When the goods are returned to the registered person, or for the goods and the valid reason to the registered the registered person decide for business reason to reduce the value of the supply after the issue of tax invoice, a credit note shall be issued for the amount of the reduction, provided that the credit note may be issued only within 6 months after the issue of the relevant tax invoice. The credit note will capture the reduction in tax charged, i.e., output tax for credit note issued and input tax for credit note received. What do I mean here? This thing, when I say credit notes, let's say I sold goods to you, let me just illustrate this one for you so that you're able to understand what it's all about a credit note. When do we issue a credit note and when do we issue a debit note? So let's say I sold goods worth 5,000. Let's say 500,000. Now, I sold to you 500,000. Now, after I have sold to you 500,000, you as the purchaser, when you purchase the goods from me, the amount was 500,000. And I have raised a tax invoice for this. I raised a tax invoice of 500,000. Now, in the course of the business, you returned some goods. Let's say worth you returned goods worth 100,000. You return goods worth 100,000. Now, when you return goods, me as the seller, for the benefit of you as my customer, for that relationship, I decide to reduce the goods from 500. The goods will decrease from 500 to 400 because of that reduction. Now, I have to generate a credit note for this 100. Now, for this case, we said the credit note will capture the reduction in tax charged. Now, if I'm the one sell the goods, output tax, if I'm the one who issued the sales, then it will affect my output tax. But if I'm the one who received, then it will affect it will affect my input tax. So this 100 reduction of the 100, you have to generate a tax credit note for it. Next is all about debit note. It is now the opposite of it is the vice versa of credit note. Debit note now, when a registered person has issued a tax invoice in respect of the taxable supply, and he subsequently makes a further charge in the respect of that supply or any transaction associated with that supply, the person shall, in respect of the further charge being made and issue a debit note and shall show on it on the details of the tax invoice issued at the time of the original supply. The debit note will capture the additional tax charged, output tax for debit note issued, and input tax for debit received. So this is just the reverse for the credit note. For debit note, let's say it is 500,000. Then now you have to increase 100. That means you get now 600,000. The price has increased from 500 to 600. That means now the 100 increase 100 is a debit note. If it is a debit note issued, it will affect the output tax. And if it is a debit note received, it will affect our input tax. Lastly, we need to talk about VAT tax inclusive, which is the net amount. You can apply this formula if you have when you want to derive the VAT amount for a tax exclusive or net amount. VAT will be given by X over 100 times the tax exclusive amount, whereby X stands for the rate. X stands for the rate. For examples, we have sale of mobile phone, 200,000 December 2021. Remember, December 2021, the rate was 16%. Now, X is 16%. We just apply 16% of 200 directly to get that 2,000. That is if it is exclusive or net amount. You just apply directly the way you just apply the rate directly by taking 16%. But if the VAT is inclusive, you don't apply the rate directly. This formula can be applied to derive the VAT amount, whereby you take that X, then you have to add the X plus 100. So if the rate is 16%, you take that 16%, but you divide 16 plus 100, which is 16 over 116 times 200, you derive 27,586. You can also, instead of applying this formula, you can also reduce, you can also get this, what we call, by first getting what we call exclusive amount, tax exclusive amount. You can also apply by getting tax exclusive amount, so that you can apply the rate directly, whereby you take that 100, then you divide the 100 plus the rate. Like for that example, our rate was 16%. So if you take 100 plus 16, that is 116. If I take 100 of 116 times 200, this 172, 414 is this is the exclusive amount. Then you just apply the rate directly. Now, for this question, you can do it in two ways. The first one, when VAT is inclusive, you just take 16 over 116, the rate over the 100 plus the rate, 16 over 116 times 200. That is the first case. But I just advise you to go with the second one, because there are some legislation that require deductible input tax, and that deductible input tax will be based on the tax exclusive amount. Now, you first get the tax exclusive amount by taking 100 over 100 plus the rate. This rate was 16. 100 over 100 plus 16, that is 100 over 116, multiplied by 200, then you get the exclusive amount. Then just get the VAT by taking 16 over 100 times that. So if you look at the VAT is just the same, 27,586. So that's all about this class. The next class, I'm going to have an illustration for accounting for VAT. Just for this class, it was just an introduction so that you're able to know those background of VAT. So I'm going to bring a calculation question where we are able to see how to account for VAT. Hoping to see you in the next class. And if you are coming here for the first time, kindly subscribe to the channel and ring and turn on the ring notification bell so that you're able to see any update whenever I post a video. Thank you.